Okay, so here we are. Now what do we do? So there's a bunch of choices, and a lot of people don't know all of those choices. So what they do is they're like, well, I think I'm going to just throw my hands up and walk away. Or, you know what, I'm just going to wait until the bank comes and they foreclose on me and kick me out. I'll wait and do that. Maybe I'll just do a short sale and, well, I can save my credit. Sure, that's an option because you get a better chance of saving credit with a short sale. And then you've got, oh, well, I'm just going to not do anything. I'm just going to wait and see what happens. This is where some people will get paralyzed, not sure what they need to do, and they just hope that it will go away. There's also bankruptcy, and we're going to talk about all of those options. And again, those are options, and there's really not a perfect option. Basically, there's a lot of evils out there, and our goal is to be able to give you the information so you can make the healthiest decisions for you, so that way, out of all of the evils, the lesser of the evil is the one that you can stomach and move forward and get back on with your lives with. So the options, here we are. A, you can continue to pay the bank. Well, we learned by that previous graph that that's a lot of money that continues to go into the bank, and will it ever pay out? Some homeowners will look at option B, which is, oh, I want to borrow some money from friends or family. I think it disappeared. Here we go. However, I'm not related to Oprah, and so I called and I said, can you help me? I've got a few properties, and no, that's not going to work out. Even if I was to, in this industry, lose a job and try to get back in a job, maybe I can get my family to help me for a month, but not in this type of an economy where the market has come so dramatically down, and it will take years. And that 13-year timeline that I showed you on the previous slide, that 13 years is really a low estimate. I know people are hearing more like 20 years. If you did the math on a $100,000 home and you just add on that 3.5% or even the gracious amount of 4.5% every year for the appreciated value on that home, $100,000 is only going to appreciate $4,500, or we'll round it to $5,000 by year 2, another $5,000 by year 3, another $5,000 by year 4. And as you can see, that's going up very slow. And if you do the math, then it's not putting a lot of equity back in the pocket based on the 100-year timeline. So what is our next option? We can rent out the home and become a landlord. And that's possible. However, what I'm hearing is the homeowner says, I'm going to rent it out. We're going to go ahead and get someone in here. They're going to offset the mortgage. And what they're finding out is that no one wants to rent for what the old mortgage amount was. So we got homeowners that are coming out of pocket to still pay for that property, and they're upside down. And then the house is starting to look a little like this because even the tenants don't care, and they're starting to, have issues with the home in regards to not taking care of carpeting, repairs on the property. And so a lot of homeowners are getting a little distressed with that because they find out, well, I tried to do this, I considered it, and all of a sudden I had a water heater go out and I'm paying for this, and the tenant didn't call me for 3 days, so now I got mold. And all these expenses start to fall onto the homeowner. So then we have what the banks will recommend, which is usually loan modification. So let's talk about that. One of the things that I find out is people they come into my office and they say, I've tried to do the loan modification and I don't understand it. The bank has asked me for a wealth of information. They want a hardship letter. They want my taxes. They asked me for this letter of explanation of what's going on, and they've done it 2 or 3 times. Why is it that they're not helping me? Well, they're looking at the information, that's sure. But what they are doing by putting you into this state is they're getting you to answer questions that you may not have had to answer. It's almost like going to court to some extent without a lawyer. And the reason I say that is because they're taking a snapshot of you in today's world, and you may have gotten your loan 10 years ago. And if you had your loan 10 years ago, who knows what job you had, et cetera. But they want the updated picture, because guess what the bank's their real name is? Bank of America kind of sounds pretty, but they really are a debt collector. Their job is to collect a debt for someone else. There's somebody behind that money that they gave out to you as the consumer. That person behind the money wants it back, and they want it back with interest. And if they can't get it back with interest over time, they're going to say, go get my property back. And if the property has been insured, they might make more money on the property, and we'll talk about that later on as well. But their goal is to get an updated collection picture on that homeowner so they can collect on them later on. And we see that where homeowners say, I did the loan, or I tried to do the loan mod, and I actually got the loan mod, but after I received my paperwork, they said that I'm going to adjust after my second year. The adjustment went from a 2% interest in the first 2 years, but then I adjusted 1 full point in the third year, and by the time I got to the 5th year, I was up to 7%. So what they're doing is, if we go back to that graph where the graph had gone up, the goal for that investor is to try to push people out of their home with higher interest payments now, and then be able to collect that home and higher interest payments. If you can pay the higher interest, great. But what they've done is they take that, let's say $1,500 payment, they reduce it down to $1,000 so it's more comfortable. They take the unpaid $500 and they stack it on that back end of the loan. So your principal starts to go up. Now the market might be going down, but your principal's going in the wrong direction. The market might be stabilizing, but the principal's still going up. And the market might even be good and go up. But at 7% interest, guess what's happening to that principal? It's also going up. And the unpaid $500 month after month after month is going on the back end. That's why they say, well, we're going to do your loan modification for you today, but by the way, you're going to have a balloon in 30 years. Oh, a balloon's not good, then let's stretch that out to 40 years for you. So now you got a home that you may not even live to see the end of, and the bank will get that property back for their investors, and eventually the investor will win. So what's the truth? I think this is what we're looking at with what the truth is when we start talking about loan modification. Other things that could be happening is back-end insurance. So they might be entertaining you for mortgage insurance while you're filling out all this paperwork. Well, what is mortgage insurance? Mortgage insurance benefits somebody. Is it the homeowner? Is everyone familiar with mortgage insurance? Well, I'll go ahead and briefly touch on it. Mortgage insurance is when, if I'm your lender, I give you money for a loan, and I say, I want to give you 3.5% down, and I'm going to give you a mortgage insurance requirement that protects all that investment from me over to you. So I'm going to have insurance bought at your expense and tack it onto your loan, have you pay an upfront fee for it. But don't worry, you won't see it today because I'm going to just raise your price about $2,500, and that's what you're going to mortgage out on your property. And then I'm going to bill you about $75 to $150 a month until, for the life of the loan, or until you dispute me. And has anyone ever disputed their mortgage insurance to try to get that waived off their payment?
After a couple of years.
After a couple of years,
Yes.
Okay. What do they need?
Oh, it was a decade ago. I don't remember.
Okay. They're usually going to ask you for an appraisal, and that's because they want to know that there's 20% of equity in that home. Why? Because it's equity that they can potentially foreclose on if you don't pay. The other thing too is they don't want to not get that extra $75 to $150 a month. They don't want to just let that go. So that's why they're waiting for that 20%. So again, the homeowner or the bank, who benefits? We definitely know it's the bank. Now, is there a mortgage insurance out there for a homeowner? There is. It's rare. There are some, or actually one lender that I know of that does it, but we're going to have a lender speak a little bit later in regards to how to get back on your feet, how do you take advantage if you still have good credit now, what do you do with your good credit now if you're worried about having to have a property go, or if I do have a property go, how do I get back on my feet the fastest, and when can I get back in the market? So another thing that the bank does while they're doing that loan mod entertaining is they're actually looking at a few different things. If they didn't have back-end insurance on you when you bought the property, they might be shopping you out with your loan modification information to show what a prize product you are, so they can take your loan and sell it to someone else. How many of you have had a loan and you thought it was with Bank of America, and then a year later you found out you were with Chase? Or it was sold to someone else. Or you got something about MERS. What's MERS? MERS is a mortgage electronic system that basically takes servicers and swaps out the servicer many, many times, and it's flipping the loan through this system. And so sometimes people don't know who their actual owner is, who their investor is, because in the back end, the bank is selling that loan over and over again because there's money in that as well. Actually, I'll go back to that slide for a minute. The other thing that homeowners don't realize is there's something called derivative swaps or credit derivative swaps that have been put onto our home product. And what that is when a bank gets deregulation through the political system that we have, they get deregulated so that way they can do things creatively. And they do that through our stock market. So we got Goldman Sachs. And what they do, and this is just an example, they put together a deal with FDIC to allow them to get insurance against you, the back-end insurance. So if in the event that you fail on making your payment, they still get paid. Okay? A lot of people don't realize that. So you're like, wait, they scrutinize me to get this loan, and they tell me I'm qualified to get the loan, and then all of a sudden, I can't make my payments, but nothing changed in my life. What happened? Some people call that predatory lending, and usually where predatory lending occurs, people find out that they may not have had insurance to begin with, but suddenly when they try to negotiate with their loan, they can't get that loan sold because the investor is not going to give up the product until it goes into foreclosure. Why do they want it to foreclose? Because that little certificate says there's going to be a payout, and it's usually from this company right here, AIG. So if we can all think back, Bush was in the presidency, and he was going to get ready to hand this over to Obama. And there was this big situation where we were talking about AIG needing a bailout. So what happens when these companies, these companies and their investors start claiming insurance from this company, and they start to lose money. And then this company starts to get to a point where it has to go out of business. If this property or this company goes out of business, they go back to FDIC and they ask them for what? Anyone?
Bailout.
A bailout. There you go. What's the bailout do? The bailout takes the taxpayer money, gives it to this company to keep them afloat, and this company then can continue to pay this company all the money so that way they can tell their banks and their lending industry keep foreclosing because we're still going to get ours from this company. Now, going back to when Obama took office, there was $750,000 of a bailout in his first year. By the time he got into his second year, there was over $150 billion bailed out to just this one insurance company. That one insurance company put other countries into bankruptcy. I think it's, I'm going to misquote this, but I think it was Iceland is one that is suing the United States for allowing it to happen. But this company was insuring their loans over there, and they basically collected a lot of money. So what is the derivative swap and the credit derivative swap? Well, to make it as easy as possible, you got some commodities, you've got some bills and regulations, you got some changes in Congress, there's some people that are getting money through lobbyists to make these laws to allow the banks to do whatever they want and to actually do stuff with the stock market. A lot of that's confusing, and the reason that it's confusing is they want it that way. They need it to be confusing. But I think the slide that best explains it is basically you have an insurance company and you have an investor. The investor says, I don't want to lose on my investment, so they go to this company and they say, give me insurance on this. And they say, well, it'll be a derivative. You can get a derivative almost on anything. But then they take that information, they say, oh my gosh, this is a hot potato. I got to get it out of my hands because it's bad. It's a bad deal. What they do is they go to their stock market shareholders over here, those are the speculators, and they start selling off their shares to them, so they make money, and then these people are going to make money as well, all on sometimes the same loan. In some cases, I've heard, I haven't seen it, they've actually sold insurance packages on one house 600 times. So that's why when we go back to the AIG having to pay this out, when people are claiming their money, they're trying to get that money through those derivative swaps. Any questions so far? Okay. I hope I'm explaining that pretty well. If I'm not, I definitely would enjoy to have some questions from you. But there's a few movies out. One is by Michael Moore. Another one is Charles Ferguson, Inside Job, and also Too Big to Fail. What these movies do is this one shows from the homeowner's perspective of what's happening in our economy. So if you want to write these down, they are great movies. They're all on DVD. Tells us exactly what's going on from a homeowner's perspective and what they go through and the fight that they do to try to keep their home loan. Inside Job looks at it from the banking perspective. It's almost a documentary in regards to why the banks actually set this up to fail. They created a profit system when the market goes up, and they created a profit system when the market goes down by back-end insuring. And these regulations all happened literally back all the way through the Reagan years, all the way up to today, and that's pretty well explained in these movies. And Too Big to Fail, that basically goes into the AIG bailout. So you'll see Paulson in the position he had with the Treasury and how he was working with Goldman Sachs, Lehman Brothers, etc., to do whatever they could to put together a big patch out of the taxpayers' dollars to bail out all the banks. And that explains that pretty good. But again, that bailout, it didn't, I don't know about you, I didn't get any of it in my pocket for me and my properties. Is there anyone in the room that can maybe raise their hand and say how much money they got on the bailout? I don't see a lot of hands, so I think we'll move on to the next slide. Next option. All right. Loan modification, actually, before I leave that, loan modifications, even if you get your loan modification, has a 97% fail rate. So why would a lender give you a loan modification with a 97% fail rate? It's because they're looking for time. They're looking for time to get a better picture on you, to find out if you have any assets and how do you protect those assets. That's a good thing that we're going to be talking about here a little bit later, how to protect assets if you have them. Also, they need that time to maybe sell that hot potato to someone else. And in my world, I'm seeing a trend. There's Faso Bank, and I see that Faso is taking over quite a bit of loans from GMAC, and so there's basically they're creating sub-companies that buy bad debt, and all they do is they sit like sharks, and they're waiting for someone to step in the water and bite, and they wait on time, and they wait for statutes in every state. So for instance, Nevada, their time frame to bite you if you let a home go into foreclosure is usually 6 months for an owner-occupied home. For those of you that have multiple homes, they're going to do a check on you to see what you got because you volunteer all your paperwork in the loan modification, so they know you got multiple properties. They're going to take that information, they're going to say, oh, well, if we let them have this or let this foreclosure go through, we still have these other two properties. It's just a matter of when are we going to bite and put a lien on those properties. So, you know, and or maybe you don't have anything now and you win the lottery later on. They might be watching for that too. All right, so the next option, modifying the payoff or a short sale. How do you modify a payoff? You basically say, I owe you this much money. It's only worth this much today. Let me sell it and modify the payoff to today's value. Let me be free of my responsibility with the bank. Please put this in writing so I can move on with my life. That's basically a short sale. So you're shorting the bank. They wanted this much. They're only getting this much. They are short the difference. Now that difference is called the deficiency. A lot of people say, oh, well, they're going to chase me for that difference, and that could be true. With the programs that we have, our goal is that that won't happen, though. I only see them going after deficiency about 10% of the time. The other percent of the time, they work something out, and that's true for investors as well. You got to give it a shot or you'll never know. If you don't do anything, then you'll just keep bleeding on your one property or your two properties or your 5 properties, and you'll never know. But I work with investors, and there's no rhyme or reasons with when you have to share in a loss with the bank, but I've worked with investors that are $5 million liquid in the bank, allowed to do a short sale and not have to pay a nickel to get out of the deal. And I've had the brokest of broke person that was told, if you don't come up with $5,000, we're not letting you out of this short sale. There's no rhyme or reason. It's because these servicers read guidelines. Those guidelines are given to them by investors. Those investors say, yes, we'll play, or no, we won't. So the goal is to get through that to find out where you stand. And granted, if you said, well, I owe you $100,000 that you're not getting back, if I can give you $1,000 or $5,000 to go away and not have to pay the $95,000 and you put that all in writing, let me do it. And then at least that way you're back on with your life. Some people can do that in a balloon, some people can do it over time, and again, some people don't have to do it at all. It just depends. Let's see. So the better route, benefits of the short sale. What I have found, and by the way, all these slides, the way I'm laying them out, are usually the layout of the way that you should entertain thinking, what should I do? And the reason that I say that is because they're going from no cost to, at the very end, what costs money. And the goal is to try to solve this problem with no-cost solutions as best as we can. And if we have to pay money, pay the least amount of money, but don't walk into the door the wrong place that's going to charge you up front and maybe not get you the service that you want. And we're going to talk about that. And today, some of our speakers that are here today will be able to add to that based on the stories that they see. So, benefits of a short sale. What I found, homeowners have the most control in this position. It's because a homeowner still owns the home in a short sale. They get to say, I'm making the final decision. They get an offer that comes in, and then as the offer comes in, they say, you know what? I agree with that. I'm going to let that go to the bank. And the bank says, I agree with it too. Let's put this in writing and get this deal done. The homeowner says, oh, but in writing it doesn't say you're not going to chase me in the future. I need a deficiency waiver. How do I get that? Well, with our services, we kick that back and try to get that deficiency language put in. Does it happen all the time? No, I already mentioned before, we got about a 5 to 10% chance that it doesn't work out. But it can be bought out. You can pay them to go away and get you the language that you want. That has happened. Or you can argue it out. And if you don't pay them directly to do it, you can always pay an attorney to do it. And sometimes attorneys work and sometimes they don't. So the network of people that we have with our organization are the ones that I think that you should talk with first, because we're going to talk about what you can get from them where there's no cost, where there's no advance fees, and where there's discounted fees. And or you can go out to the billboards that you see. And I'm pretty sure one thing I can guarantee about them or the commercials that you're seeing online is that there's going to be an upfront fee for service, maybe. Maybe it'll be rendered, maybe it won't. All right, so what are some benefits of the short sale? 1, the homeowner has the most control. 2, you can probably stay in the home. For people that are renting out the home, they're going to be able to get some rent during this time frame and maybe save a little bit of money. Another benefit of the short sale, save the money in the process, okay. Save the money because you might need it to move into the next property. You might need to put it in an estate plan to protect it, and we'll have an attorney speak to that here a little later today. You need to know where you stand with the bank. That's a good thing about the short sale, because if you did the short sale, again, they give you a letter. You know where you stand. If you say, I'm going to stick my head in the sand, you don't know what the bank is doing. You don't know where you stand. You don't know what they're doing. Or you might call them, and customer service sounds really friendly when they're on the phone with you. But customer service works for a debt collector. They have been trained, guaranteed, to collect. So they're going to be nice and friendly with you until you tell them, I'm sorry, I don't think I can afford my next payment. Then suddenly they start putting collection tactic on you. The other thing that you will find is maybe they'll say, well, let's put you in our friendly home retention program, and that's to put you into a loan modification. Well, their job is to also collect. And if you're not talking with them, then you're hearing them calling you or leaving messages, and that's the debt collector, and they're not so friendly. So another thing about benefits of a short sale is you don't have upfront fees or advance fees. So when you see the attorney ads and whatnot that are out there saying, I can short sell your home, you're paying them to start to do the job. And then what they're going to do is they're going to hire an agent and or an in-house agent, or sometimes the attorneys will be licensed to be able to do it themselves, but they're going to usually charge you an upfront retainer fee to do that. The solution to that is work with a real estate agent. The real estate agent is going to be able to basically work where they get paid for services rendered, meaning that if the deal doesn't close, they're not getting paid. And granted, every realtor has a different model. Some of them are doing upfront fees, but if you work through our network, we'll get you in the right hands. Of course, I have my real estate license, and you'd be able to work with me directly, or any associate that I have, or anyone that would be in the network. You have no future credit ramifications and or less future credit ramifications. The reason that it's no is it's rare, but sometimes the banks will make a deal, if you give them money, to positively report on your credit that you never had a derogatory on your loan, and then you can move on and get a house. Literally, I've seen it in 6 months. I've also seen the bank make a mistake where there has been derogatories of missed payments on someone's property for 4 months. The home sells as a short sale, and then all of a sudden the bank closes the deal and it shows on the credit report as a modified payoff, and now it's paid in full. And the current balance is 0. The key is the word current balance being 0. That C goes on the credit report and repeats itself, and we'll have a slide coming up that will go into that a little bit further. Another benefit of the short sale is you haven't had a bankruptcy and or the costs or any penalties of doing that. Bankruptcies cost money. Usually if it's a Chapter 7, you've got to qualify for that. And a Chapter 7 is going to be less money, and that would be a total wipeout of debt. But now you're going to have to start paying fees. But you've avoided that with a short sale. So why not try another solution first? Because in a bankruptcy, you're usually going to have to give up something. And maybe it's not the house that you're in, but you will have to still pay on that house. Not during the bankruptcy period, but as soon as the bankruptcy is over, payments resume as normal. And what I've seen is that when you're not paying during the bankruptcy, the bank is taking your unpaid payment or any partial payment that you've got that does come in, and they're putting it in suspense. And we're going to talk about the difference between your actual account and a suspense account here down the road. Okay, tax gains. There are benefits to selling as a short sale. When you bought your house, or if you've ever sold a property, when you went into the title company, you had to do some documents. That's a HUD settlement sheet. That shows you the receipt of exactly what the expenses were on the file. Those expenses are in your name when you were the owner of the home, so those are expenses to use as a write-off. Now, when you own the home, and you're making your payments, usually you're getting your tax deduction of your interest payment as your write-off. When you sell a home, you can go back in and start to add on costs, and investors usually know this, for improvements. And they go back and they get the original HUD settlement when they bought the home and the settlement expenses of when they sell the home at this period of time. They add all that up, they take it to their tax man, and their tax man says, oh, you have a loss. Let's offset any future earnings that you have. So a lot of homeowners don't know that, and ones that walk away don't realize that when you walk away, the deed will switch back in through the foreclosure process into the bank's name, and the bank is going to sell the home. They're going to get those tax benefits when they sell, and then they're going to have the deficiency where you owed to what you could have sold for in this market. They're going to add on the cost of real estate costs, closing cost, the buyer's costs, the house was broken into costs, the repairs costs, the new paint job, and this is what's called a deficiency, and they're going to say, we lost money from the bank. We want a write-off. They're going to 1099 that, and who do you think gets the 1099? The homeowner. The homeowner gets a 1099, and then some people say, well, what's the big deal about that? Well, the big deal is the IRS also gets a copy of that. So the IRS now is under the impression that you benefited from the bank in some way, shape, or form because you didn't pay this debt. So now you have tax responsibility on that debt. So if it was, for easy numbers, $100,000 and you're in a 20% tax bracket, who knows the answer? How much do you owe the IRS? $20,000. So how do you offset that? Well, if you had the home and you owned it in the short sale, you would be able to use those expenses that were gathered up from when you bought it to when you sold it, and any improvements along the way, pools, landscaping, paint job, dig up those receipts, give them to your CPA, and talk to your CPA about this conversation. Now, here's my disclosure time. I'm not an attorney. I'm not here to be your attorney. I'm not a CPA, and I'm not here to be your CPA. But I'm talking to you about what you should be talking to these people about, and I'm happy to talk about that all day. I'm not here to give you the legal advice or the CPA advice, but I am telling you, from my advice to you is, just talk to them about these topics. If they forget these topics, if you're working with us through the network, we will be able to talk to your CPA directly and or refer you to CPAs that understand this, so that way you can move on. Let's see, other benefits. Faster recovery on the credit. So we talked about one way the bank could either make a deal with you to give you your credit back, or they can make a mistake to get you your credit back, and or you can just wait for the natural time frame that it takes for the credit to rebound. So I haven't missed a payment, I'm going to sell my house short, how fast will my credit come back? Usually, you're not going to have a derogatory on your FICO score, so that means that your credit's going to come back a little bit quicker. It usually starts to adjust back up, and it shows on the credit report a modified payoff, paid in full, and it usually tends to creep back up in about 6 months. But the lenders are not doing any loans to anyone really until about year 1. And we'll have a lender speak to that here later on. And then the loan product for that is usually a conventional or 20% down program, so it's not the end of the world. There's also some award-winning banks that are out there, like the NACA program. They will allow you to get a loan after 2 years with less money down, usually 0 to whatever you feel like you want to put down. But that program, again, has to have you in their network, and we can get you to them as well. And our lender today is going to speak of what you can do with the FHA programs and the conventional programs that they have to offer. Okay, you have the potential for relocation programs when you do a short sale. So a relocation program, a lot of homeowners don't know exactly what that is. If you need help getting out of the home, there's some government assistance programs, there's some state assistance programs that get government funding that help homeowners get out of the short sale situation and help them with a move. We can't guarantee it for all people, but what we can guarantee is we try to get it. Depending on who your investor is, the investor can voluntarily opt in. Of course, you say, I'm mandatory filling out the paperwork, I want the extra $3,000 or $6,000. But what ends up happening is the investor can volunteer out of the program. All right, but the goal is with the short sale, the goal is to be able to know where you're at, to give you the peace of mind, and ultimately reach your goals and get back on your feet. Get to where you have your life back in your hands and know exactly how it's going to play out. So again, going back to how does it affect the credit? FICO, what is that? A lot of people are not sure. It's basically a scoring system with mortgage, credit, automobile loans, residency, and employment, and they build your FICO score. So some people are like, hey, I haven't been making my payments, I checked my credit, I've got a 540 score, that's still good, right? Well, not good for getting a loan, but it still shows you that even though you may be missing payments, your credit's not totally shot, you still have a score. It's because the mortgage score here is being affected somewhere about 170 points. And then what will happen though is once you have derogatories on your mortgage, then your credit card companies start reducing your balances, and then you start going over, and then that starts affecting your score. So this is where the biggest hits are. And unless you're not paying in another one of the area. So how fast is it to rebound? So again, it's kind of like dominoes of time. When you put one current payment on your credit report, it pushes the other dominoes down the path, and eventually after 18 to 24 months, your current balance, your modified payoff from a short sale gives you good credit again. Is everyone with me? All right. Okay, if you're not, please let me know. All right, if you go into foreclosure, you got a 7 to 10 year rebound period for your credit. And a lot of people are like, well, I know people that are out there getting loans after 2 years of their foreclosure. It's true. The problem though is that FICO score is going to take out a risk factor of somewhere to 3% and above, or you're going to have to go to private money. Now, I've done private money before where I've loaned it out, and I've actually had some clients that needed private money, and that private money in today's great rate market is about 9% interest. So you can get a loan, but you're going to be paying for it if you have issues on your credit. Okay, so far, as we mentioned, we're talking about things that are not costing you money at this point out of pocket for the services to be rendered. Deed-in-Lieu, sometimes people will call the bank and the bank will say, well, you do have the option of deeding the property in lieu of us foreclosing on it. And people are like, oh, well, what does that mean? They basically say, you give us the keys and then you don't have a headache anymore. But they leave a few other things out. It sounds good, but they leave a few things out. We already learned that the tax benefits will swing immediately to their favor, because it's just like if I said, hey, I know you can't pay, I'm knocking on your door, why don't you just let me worry about the problem? Deed your property to me. Now I have the problem of making the payments, but I also have the tax write-offs when I go to sell that home. So that expense will go into my favor to offset. And the bank still will put you on your credit as a foreclosure. It'll say voluntary foreclosure. And then when you go to get your loan in the future, again, you're waiting 2 years now still, so it didn't work out overall, and you still have the higher interest rates on anything that you're going to buy. Okay, so again, that's the deed-in-lieu. All right, the next option is foreclosure, and with Nevada we get a little extra boost called mediation. And foreclosure is basically the bank is going to get the property deeded back in their name, and they're going to do it through the legal ways of what Nevada allows them to do. Every state has a little bit different changes in their laws, but in Nevada they do that through a 90-day advertisement period, and we're going to talk about that coming up here in a minute. And then you've got when that default notice comes out, it's going to come to you in the mail, usually 6 different ways in 6 different times. And they'll also give you one noticeable way, and you probably all have seen it in your neighborhoods now. It's where they have the notice on the door, the garage, there's blue tape. And that's basically day one of a public notice that the property is in distress. The bank, based on Nevada law, is going to need 90 days to advertise that period, but we have a 30-day window once the notice is posted and delivered that you can do the mediation. And what mediation is, based just like you see here on the picture, you got this guy here, he's friendly, he's a mediator. He's there to witness what happens between the homeowner and the bank. So some homeowners say, well, I'm going to do this myself. Great, that would be you by yourself. And this would be the panel of people that the bank is going to send in against you during your mediation. A mediation is usually going to have a few solutions. The solutions usually are modify the loan, do a loan modification, which you know is going to be for the investor, and or they're going to say, let's modify a payoff and do a short sale, and you can do that in the mediation, and or they'll take the house back through the mediation with you voluntarily cooperating with them, and they might do the deed-in-lieu. So just for visual and clarity on that, how does this time frame lay out? Day 1, notice of default. 90 days, they advertise the home. After 121 days of advertisement, they will put a trustee sale date on the home. That's when they go to the auction and say that we are going to auction this property off, and whoever's the highest bidder usually gets the home. If no one bids at the original loan amount or the reduced loan amount, then the property goes back to the servicer, and the servicer sells the home through foreclosure and hires an agent. As I mentioned before, the first 30-day period here in Nevada, you would have to fill out some paperwork, get that in. The mediation program allows you to, again, talk with the bank for a better solution. It does allow the time frame to keep going, but if the mediation date is not set till, let's say, day 200, you bought a little extra time. Even though this clock has spun out of time, they cannot foreclose on you to do the trustee sale date until this meeting has occurred if you fill out your paperwork. And I say if because some people say, I don't want to pay $200 to fill this paperwork out. And they don't. And then what happens is the clock keeps ticking and boom, here it is. Or they say, let's mediate and give it a shot. And when they do that, then we have the opportunity to try to come up with a solution right in the mediation. And the beauty of that is it's a smaller time frame. So let's talk about mediation. Mediation, can I do it myself or do I need a lawyer? And this is my segue. I'm going to invite attorney Crystal Eller up. Crystal, give her a round of applause, please. Crystal is a state mediating attorney here in town. She works as the mediator, the friendly person I mentioned in the center of that table. And she's also worked on the side of the homeowner as well. So what I'm going to do is I'm going to let her talk about a plethora of stuff. She's a wealth of knowledge, and I definitely want you to ask any questions that you have. And I'm going to turn the floor over to you, Crystal.
Thank you. As Don said, my name is Crystal Eller. I'm an attorney, been licensed in Nevada for 20 years, and around 09 and 10, I was a judge for the municipal court, and I resigned, and I started taking cases, and you look for the work that's out there. I do criminal defense, but in addition to that, I started taking on cases as the, does anybody have any tomatoes? No? Okay. Because I represented the lenders at mediation. So that's how I first started doing this kind of work. The good news is because I have some really good insight on what they need in order to say yes at mediation or modification if that's what you want, as well as short sales. But as I moved into this world of representing the lenders at mediations, I was very interested in the mediation program. I learned about it. I compared it to other states and what's going on with other states, and we are the leading mediation program in the country. Our mediation program is very, very good, and it's actually the model for several other states at this point. So what happens in the mediation, as Don said, you get your notice of default, you get your blue tape on the door, get certified letters, and in those certified letters, the banks are supposed to include paperwork about the fact that you can elect mediation, which they don't always do, but let's say you actually find out about it in a timely manner. You fill out the paperwork, and you have to send in $200, and then the bank is compelled. Your lender must then also send in the $200 and must show up at the mediation. If they don't get what's called a certificate, because as soon as you guys fill in that paperwork, send it into the program, the foreclosure is placed on hold and it cannot go forward until they get a certificate from the mediation program. And the only way that's going to happen is that mediation has to take place. And during the mediation, if no agreement is reached, both parties showed up and tried to talk and mediate in good faith, then the bank or the lender can apply for the certificate and they can move forward with that foreclosure. However, that's a lot of ifs. If you are, as the homeowner, you go to the mediation and you're there in good faith and you've got all your documents and you've sent them this plethora of documents they've asked for over and over again, and the lender comes, well, the lender has documents they have to have too, and that is, again, why one of our mediation program is so good. They have to have a certified copy of the original note that you signed. They have to have a certified copy of the original deed of trust that you signed. They have to have certified copies of any and every assignment of that deed of trust all the way down the line, no matter how many times they sold it. And endorsements on the promissory note transferring it to who it's supposed to go to. So my personal recommendation, and not just because I do this, partly for a living, but to protect every single person out there, I wish everyone who got a notice of default would go into the mediation program, because it gives you a chance to sit down at the table with the lender or somebody with authority from the lender and actually talk to them. Which, as we all know, if you've done any negotiating or communicating with the lender, how difficult that is to get somebody on the phone that you can talk to, much less somebody with authority. But the other reason is because when you get to that table, if they don't have those documents, every one of them that they're supposed to have, they're not going to get a certificate, which means they can't foreclose, they have to go get their ducks in a row, they have to file a new notice of default, and then you can elect mediation again. So it really protects the homeowner. So if you or anybody you know is getting a notice of default, you know, it's a great idea to elect the mediation. And the other thing is, if you're in the middle of a short sale and your negotiator, whether you've hired an attorney negotiator, whether your real estate agent is helping you, whether you're trying to help do it yourself, if you're in the middle of that and you're not getting answers from them or you're having a hard time with them, you get to sit down at that table at the mediation and say, okay, you know what, I don't want to keep the house because I know no matter what I can't afford the payments. I want to short sell it because I want to help not do so much damage to my credit. Let's talk about that. And the mediation rules actually mention short sale. So they have to evaluate you for modification if that's what you want. That's part of the rules. If they show up and just go, you know what, yeah, we got all our documents, that's all we're going to do, we don't think she qualifies, that's not in good faith. So if the mediator finds them in bad faith, or they're in good faith and they're there trying to negotiate, but they can't get somebody on the phone that has authority to give you an answer, yes or no, then they don't get their certificate for that either. So the great thing about it is they have to be there, they have to have authority, they have to have all of their documents, and if they don't get the certificate, and they have to start over again. So that it's the only thing that I know of that actually gives the homeowners some power, some authority to do something about their situation, and to have this huge bureaucracy of these lenders have to answer for what they're doing and the fact that they're not generally cooperating. So I recommend having an attorney, because especially one that's got a lot of experience. Like I said, I know what to look for. I know what all the statutes say. I know what the mediation rules say. Also, I am a mediator. I became a mediator. So having somebody that cares with that kind of experience on your side sitting at that mediation is going to make sure that all the rules are followed by the lender. And if they're sitting there saying a lot of really fancy stuff, but they really don't have any authority, you might not be able to recognize that when somebody with experience that's there to help you would. Any questions?
Okay, I'm going to add in. So how do you do a mediation if you're doing a short sale? The example would be this. Usually what happens is, if I'm doing a short sale and I see that we're having trouble with the file for one reason or another, and we see that the notice of default timeline still going and the bank is basically lying to us on the phone and moving a different direction with action, we're going to go ahead and set up a consultation. Crystal is one of the many attorneys that we have in our network that we would do a consultation with. And the way that works is, anyone in the network needs to minimally give a free consultation. The good news is you get my information, she gets a briefing of my information. We look at that in a snapshot of literally 15 minutes. She knows the story from back to forward, and you've got another 45 minutes of free time with Crystal to make sure that you are looking out for what the healthiest decision is for you. What happens is that, what would you say, that little powwow there, the meeting of the minds, gets us on a goal. And the goal is, what are we going to do to attack this bank from a different angle? Now, Crystal offers additional services too. As she mentioned, she also does the loan modification as well. But if we're going to work with Crystal, she's going to also do a discounted service, which I've seen her do in the past. But the beauty of what I've seen with Crystal when I'm working with homeowners at the mediation table is the banks do not have room to wiggle. And I've seen her scrutinize the paperwork. She does a phenomenal, phenomenal job. And in every mediation that I have been in with her, there has always been a solution and an outcome that the homeowner wanted in that. So I know that these other attorneys are out there charging $3,500 to $5,000 to be able to do that. I know that when our company is doing the negotiation on the file and we put that paperwork in front of Crystal, she does it at a reduced amount. Where are we at with that figure? In today, remember this is taped, so this could change based on the economy. But as of today,
$1,500.
Yeah, and
that is partially because if you're working with Dawn, all that paperwork is put together for me.
Yeah. And the other thing too is we've got that network communication going on. If you're going to, do the mediation, again, the paperwork filing on that mediation is a $200 fee that comes out of the homeowners. It goes up to Carson City, and then they ask the bank to pay another $200. That money goes to pay that mediator, the friendly face in the middle of the table, back with that slide a few slides ago, and then anything else comes from the services of what Crystal would do for you. But that will guarantee that the time frame that the mediation starts to the time frame that it ends, so if that's a total of 4 hours, which it usually is within, is completely covered with that.
Right.
Okay. Any other questions for Crystal? And I'm going to have you give that to Augusta.
Okay.
All right. All right, so I'm going to go ahead and step back in, unless you have anything else to share. All right, so next option. Well, we've done foreclosure mediation, and now we're on to bankruptcy. There's the Chapter 7, Chapter 13. For corporations, I think we're talking about a Chapter 11. Let me see where we're at in the slide here. So let's talk about some bankruptcy. Today I was able to get a bankruptcy attorney, Augusta Massey, to visit with us today. She's also someone that's in the network. She works basically similar to how Crystal works in regards to we'll be able to get that free consultation for you. However, for the services that she renders, then that would be something different. So again, out of all those options, we're only getting to the expenses when we start getting into the bankruptcy. So Augusta, can we have you come up? Oh, okay.
So,
Have you trade off the mic. I think it's probably easier that way.
You have a skirt. Oh, I see you later.
So again, everyone give a round of applause to Augusta while she's figuring out her mic.
Yeah, thank you. Nothing like
Thank
forced applause. Thank you, guys. Thank you for having me here, Don. Good evening.
You're welcome.
And I'm just going to be really brief. I call bankruptcy the nuclear option. By the time you get to bankruptcy, just like he said, you would have gone, I don't know if you have the other slide back up, you would have gone one of these options. You would have at least considered all of them. By the time you get to me, you would have decided, okay, at this point, we've tried all the other options, and bankruptcy is where I need to head. In bankruptcy, you have, for individuals, Chapter 7 and Chapter 13. With Chapter 7, I call that a liquidation option. That's when it's a give and take with the bankruptcy trustee. You put all your assets into what I call a little bag, and you hand that over to the trustee. Based on the rules NRS 21.090, there are a couple of things that you can take out of the bag. So if you have your house worth $550,000, which might not be the case here, you get to keep that. Your personal property up to $12,000, you get to keep that. Your car up to $15,000, you get to keep those things. But if you're looking at an option of trying to wipe out the deficiency, like you mentioned earlier, bankruptcy might be an option to wipe that out. With a Chapter 13, it's a little bit different. Chapter 13 is also for individuals, but it deals with people who have disposable income. So if you have a little bit of money left, or you don't qualify for the Chapter 7 based on the number in your household and how much you make per state law, you can do a Chapter 13. With the 13, however, it's a much longer period of time. Clients I see for Chapter 7, which is what I love, I've been doing that now since 2006, 2007. They changed the rules back in 2005. So they've done a lot of revamping of the law. I have been doing this since law school. I started practicing in '08, and I did it about 2 years before that. So a lot of people get into bankruptcy now, but it's always good to go with someone who's experienced or who has been doing this. I clerked for 3 different judges on the Western District of Tennessee, and it's federal law, so it pretty much carried over. So you want someone who knows what they're doing. The rules also recently changed in the state law. NRS 21.090 expanded a little bit to give homeowners a chance to keep more stuff for themselves. So that's something that you have to note. With the Chapter 13, like I was saying, that involves a longer process, 3 to 5 years, where you marshal out your disposable income and then you get to pay back your creditors over time, as opposed to the Chapter 13, where, 7 rather, where in 4 to 6 months, you could be in and out of your bankruptcy. The thing to note about bankruptcy, though, it does stay on your credit report for a number of years, about 7 to 10 years, just like the foreclosure, just like the Deed-in-Lieu. So it has that same effect. With the Chapter 7, you're in and out faster and you can get that clock ticking right away. With a 13, however, you have this 3 to 5 year period. And then if something happens to you, for some reason you can't keep on making those payments or you lose your job, it's as if you never filed for a Chapter 13 in the first place. So I do not usually advocate for a 13. And why this really should be your last option is we get very nosy in the bankruptcy court. We ask for everything. It's almost like turning on paperwork to the bank. What are your assets? What are your, what's your income? What are your expenses? Are you married? If you're married and you're not filing jointly, why is that happening? How much does your spouse make? They get very nosy. Do you have a safe deposit box? Where is it located? Any and all property in this state, out of the country, everything they do want to know. And if you have enough money, the trustee actually takes over your estate and can sell it, liquidate it, and pay that out to your creditors. So you always have to be careful before you do a Chapter 7 or a Chapter 13. As he mentioned earlier, a Chapter 11 is typically for businesses. It's very similar to the 13 in that you reorganize. You do also a payment plan just like you would do for a 13. Most individuals do an 11, but that's very rare. That's usually for independent contractors, so you want to stay away from that. And then there are other chapters of the bankruptcy code, like a Chapter 9 for municipalities, Chapter 12 for farmers. Any farmers in the house? Hopefully you're not farming in the desert, but so those are not options that will apply to you. So the big ones are 7 and 13. Do you guys have any questions for me? Okay. Nobody wants the bankruptcy option?
Well, one of the questions that I typically hear is, can I bankrupt my responsibility to the IRS?
No. Okay, let me say that's a qualified no. That's a qualified no. The rules are very strict. I get that a lot. I get IRS and I get student loans. I have a lot of folks who have, you know, all this gazillions of debt from school, and they think they can do that. Student loans are not a beast unto themselves. There are a lot of things you have to do for that. And the big thing that people don't understand is undue hardship. With that, you have to show that you are not making any money now and you will never make any money for the rest of your life. That is pretty kind of hard to prove. With the IRS, there are certain parts of the code you have had to have had the debt for a substantial amount of time, and they have to have given you a notice for also another substantial amount of time. There's a calculation that goes with that. That's very difficult to pull off. So know if you owe the IRS, like death and taxes, you always have to pay, and they have a way of circumventing that even in bankruptcy.
All right, any other questions?
Go ahead.
Are IRAs protected under either 7 or 13?
Absolutely. I'm glad you asked that question. That's one of the things that NRS 21.090 does for us. You can take out your IRAs, your 401ks, your life insurance to any limit. So I'm sure, I think there's an estate planning section.
Yes.
So they
there
will
will
probably talk more about that. But yes, it is protected. You don't get to put that into bankruptcy.
Yeah, and there will be an estate planning section that will cover that and a few other things as well.
Yes, so I'll leave that for.
Okay.
Any other questions?
All right, thank you very much.
Thank you.
You can give that mic probably to Dave.
Okay.
Thank you. Okay, so where are we now? One thing about the bankruptcy that people do not realize is the bankruptcy does not stop the credit ramifications. So if you're thinking, oh, I'm going to go bankrupt, I'm going to go run back out and start buying property in 2 years, that may not happen. And the reasons are because the bankruptcy has maybe stopped the bank from foreclosing during the bankruptcy period, but even after the bankruptcy, if they haven't come and collected the home and they collect that home in a year or 2 years after the bankruptcy was dismissed or discharged, then what can happen is it will show up on your credit report at that point and then continue to haunt you. A lot of homeowners also don't understand that you still own the home post-bankruptcy, so your HOA is going to continue with the liens, your sewer, sanitation, disposal bills will still collect on that property, and it will still be in your name. If someone was to trip, fall, sue over what happened at that property post-bankruptcy, you are now in a lawsuit, and you'll have 8 years to have to wait to get out of that bankruptcy. Another thing that I point out about the Chapter 13 is that homeowners don't realize that when they go into this restructuring debt, they're restructuring all the bad debt that's already upside down. So if you get talked into that, when you're talking to some of those attorneys that you see on billboards, and I'm not here to give attorneys a bad name, I think that some of them give their own bad name to themselves, but those attorneys that come in and say, oh wow, you only have one car and one house, oh, I think we need to do a Chapter 13. To me, that's probably the worst advice, because you could have probably done a total wipeout of debt and possibly even kept the car and the house under a Chapter 7. But on a Chapter 13 restructuring, you're not only paying for the restructuring of that debt for the next 5 years, but who else do you think makes money the whole 5 years? Well, the trustee's getting the money, and they're supposed to be paid to pay off the bad debt, but there's someone else that's getting paid the entire time. The attorney that talked you into it. Plus, you probably got an upfront fee for that too. So usually those aren't my favorite things to recommend. It does happen, but again, I'm not here to be your attorney or your CPA. We're here to get you into the right hands. So what have you learned so far? Any questions in general? Okay. One thing I like to point out here is that Neighborhood Home Rescue and that program goal is to put together all of these network of individuals together, so that way you have a choice to go from. We want to make sure that we're covering on information for the foreclosure, the mediation, the credit counseling, the bankruptcy, asset protection, and real estate planning. The reason that we go over all of these is because we know that if you just walked into an attorney to talk about this foreclosure, he's going to talk you right into bankruptcy and leave all these other slices of the pie on the table. You need somebody or a team that works with you to get you to your goal. So I'm very big on, when you're working with us, we know the information about the other parties, and when we don't, we talk with them. We also know that their goal is to work with you to get you to your outcome. So if you need to be in a place 5 years from now, everyone in our network is going to do everything that they possibly can to get you there. Of course, with your participation. We can only do what we can on our end. All right. Let me see where we're at. Obviously, these are all the options. Which ones do we choose? Oh, there is one more option. And this is the best one. This would solve everything. Let's see if we're going to get it. Ta-da. All right. So, yes, this is my favorite option and the one that I'm trying to get myself. So if you guys know those numbers, let me know. But that's basically the options in a nutshell. Anyway, which option is best for you? I think that as you see where you need to be in the most control, it's usually that short sale option.